By the time you finish watching this video, I'm going to have you really clear on the fact that you should not be paying capital gains tax. And this is off the back of the fact that we have recently seen quite a few changes in capital gains tax in the budget that Rachel Reeves introduced a few weeks ago. I'll cover a little bit about what those changes were a little bit later on in this video. But because this is pertinent to what we're going to go on to speak about, I want to tell you a little bit about this week's video sponsor, who are Plum. Now, Plum have been around for some time now, and they are offering a cash ISA, an instant access cash ISA, with an interest rate of 4.68%. Now, 4.68% is a pretty competitive rate when you consider that the Bank of England base rate recently just fell, and we're also due to be expecting another bank rate reduction by the end of this year. So when you look at the scheme of things, interest rates are coming down, and that's going to be impacting savings. So to have a 4.68% instant access cash ISA, I think is a great value on the market and very, very competitive right now. Now, there are some things that you need to know about this account. For example, the 4.68% includes a Plum bonus of 0.88%. And if you want to be able to maintain and keep that bonus, there are two things that you absolutely have to do. You need to make sure that you maintain a minimum balance of £100 in the account. And because it is an instant access account, you are going to be restricted to 3 withdrawals within a 12-month period. Now, for some people, that might be a deal breaker if you know you're going to need to access the money a little bit more than 3 times a year. But if you're quite happy to have the money sat there, this could be the perfect account for you, offering a very competitive rate. Another thing that you need to know about this is the fact that Plum is covered, and any deposits that you put with Plum in this account will be covered by the Financial Services Compensation Scheme. And that is essentially protection for you as a consumer to say that if anything were to happen to Plum, £85,000 of your money is protected, so it will be restored to you on that front. I'm going to leave a link down below for you to check out this account. Now, you can, if you want to, say you've got a cash ISA with provider Y, for example, and they're giving you only 3%, you can transfer that amount over to Plum as well. There are terms and conditions specifically around that. So in the link that I'll leave in the descriptions, please make sure that you check out the terms and conditions on that. But I partnered with Plum on this because it, number one, is very, very pertinent to what we're going to be talking about in this video. And it's a very, very competitive interest rate for a cash ISA right now at 4.68%. But there are links in the description down below. I'd love for you to go check that out and see if it is the right fit for you. I know you've not been living under a rock, so you're probably aware of all of the changes to capital gains tax that Rachel Reeves made in the budget a few weeks ago. But if you did miss the detail, here's what you need to know to bring you up to date. So if you're a basic rate taxpayer, i.e. you pay 20% on your income, so 20% tax on your income, on your earnings when you go to work, then your capital gains tax is now 18%, up from 10%. And if you're a high rate or an additional taxpayer, which means you're paying either 40, 45, maybe even more on your income in terms of tax, then your capital gains tax has gone to 24% from 20%. These are pretty big changes that were made, and it is going to impact a lot of people, pulling them into a higher kind of like tax position, if you will. Now, I want to talk to savers, because while savers don't necessarily pay capital gains tax, you do pay tax on the interest that you earn on money that you have sat in a savings account. And you don't have to pay tax on the interest that you earn on a savings account if you put it into a cash ISA. A cash ISA like Plum, for example, offering 4.68%. And really the move is very, very simple. If you have a savings account right now, which is not an ISA, you need to open an ISA and transfer that money into the ISA, because at the end of the day, you're going to save yourself money on tax. And that means more money in your pocket, more money towards your goals, your priorities, more money that you're not giving away to the taxman. So the move is very, very simple. Open a cash ISA, transfer that money that you have in a normal savings account into the cash ISA. Now, there may be some trade-off in terms of interest rate, but the key thing to remember is that essentially, if you are getting a higher rate than what could be offered in, say, an ISA account at this point in time, you're going to have to pay 20% interest, well, tax on the interest that you gain in that savings account. So there will be a slight calculation to be made around, okay, so if this account is offering you X amount and your interest is X amount, times that by 20, that's your tax take. Look at what interest rate you're going to get in the ISA, and then you'll know that because there's no tax on the ISA, you'll know whether you're saving money or not. But it's very, very simple. Put money into a cash ISA. And again, you might choose the Plum Cash ISA, paying 4.68%. Now, you need to be a little bit aware here, and I need to be a bit careful with the way I talk about this because I don't want to be giving you advice specifically. So there are certain things that I'm going to walk you through in a moment which are important. And key to this is understanding, number one, how much of your ISA allowance you've used during the tax year, and having a good understanding of how the tax year actually works. So the tax year runs April the 6th to April the 5th. What you don't want to do is you don't want to oversubscribe in your ISA. So you need to be very, very clear and aware of how much of your ISA allowance you've actually used. Now, if you have an ISA investment account, that's a big tick for you already. Plum is a provider that offers ISA, stocks and shares ISAs as well. But if you have a stocks and shares ISA right now, perfect. But for those of you who may be in a position where you've maxed out your £20,000 ISA allowance, and say you're also putting money at the moment into a general investment account, what I'm going to talk through next is going to be really, really good for you. And I'm going to talk about how you bed an ISA, your general investment account. Again, you need to be mindful of tax year and how much of your allowance you have, because it is plausible that you might have an ISA account which is nearing the limit or not quite with the limit, but you've also got a general investment account elsewhere. The key thing to remember is with a general investment account, because it is subject to income tax, dividend tax, capital gains tax, the better place for it to be is in a stocks and shares ISA. So you can bed and breakfast your general investment account and it will save you capital gains tax, and in some cases could save you quite a lot of money as well on your gains. So this is what you do. So let's just say you have a general investment account. It could be with any provider. And let's just say, for example, that you have £5,000 in this general investment account and it's currently invested in something like, say, the S&P 500. Under bed and ISA, essentially what it means is that you can sell down your general investment account, to sell down the S&P 500 investment in the general investment account, and you can reinvest in the same asset, so the same asset within 30 days without triggering any capital gains. So what you would do in this instance is you would make sure you have an ISA open, and if you do have the allowance remaining where you could sell down this £5,000 in the general investment account, you would sell down the general investment account, that £5,000 that's invested in the S&P 500, and then you would buy the S&P 500 within an ISA wrapper within 30 days. And that right there will mean that you're moving yourself away from an account that is not tax advantaged into an ISA, a stocks and shares ISA that is tax advantaged. Now, when I was a financial advisor working with clients, this is something we would systematically plan for clients almost every single year. For people who can max out their £20,000 ISA allowance, we'll say, okay, max it out, make sure you're using the full amount, because if you don't, you can't go back and use it for years that where you didn't max out your allowance. And what we would do is put money into a general investment account. And the general investment account was simply there to be a feeder into the ISA. So if there was an extra £10,000, for example, or £20,000, for example, we would put that money into a general investment account. But then at the beginning of the new tax year, we would simply transfer whatever was in the general investment account, £10,000, £20,000, into the ISA to make sure that the client is always within a tax sufficient wrapper. And this is something that you as an investor at home, looking after your own portfolio, doing it on your own, can still do, but you just need to be mindful of how this works in terms of your ISA allowance and also the tax year and what of your ISA allowance you've actually used. You know, we're talking about ISAs here, and ISAs are woefully still underused, I should say, not misused, underused in this country. I'm going to give you some stats, and this is from 2022, 2023. In 2022, 2023, only 7.9 million cash ISAs were opened. Only 3.8 million stocks and shares ISAs were opened. Now, you might think that is a lot, but when you think about that as against the backdrop of as a nation in the UK, we're a nation of 68.3 million people. And if you look at the age groups between 16 and 24, that's 43.7 million people. So over 60% of people who are either adults or coming into adulthood, most of which will be working. But still, the numbers and the utilization of ISAs is still pretty low in comparison to the populace and the number of people in the population. So I think there's still a lot of work to be done here in terms of helping people understand the benefits of an ISA, so on and so forth. But I think this moment where we've seen an increase in capital gains tax is an opportune moment to talk about this and to try and educate people on the importance of ISAs and where they fit in the financial hierarchy. Because for me, tax efficiency is the first rule of financial planning. It's one of the things that you learn as a financial advisor. Tax efficiency first. So you're always looking for tax efficiency in the right manner. And for anyone who is saving right now, you've got no excuse. You've got to put it in a cash ISA. And if you are investing, the first thing that you look at is a stock and shares cash ISA, because those are the only vestiges of tax-free allowances that have not been touched. I mean, in the budget, I was surprised that ISAs weren't touched. Thankfully, they weren't, because they touch pensions. They touch pensions big time, which has changed a lot in the pensions landscape. So please take advantage of it whilst it's still here. If you have any questions, please pop them down below in the comment section. But I'd also love to know what you think and your thoughts on this as well. But thank you so much for watching. I'll catch you later on.